Hey, it's Mrs. Simonson, and we're going to move on to Chapter 6. This chapter is titled Recording Transactions in a General Journal. Some of the basic big idea things for this chapter is every transaction you have in a business is documented in some way. And so not in a T account. We're going to learn how to do that differently. And finally, in formal accounting papers. Companies keep permanent records of all transactions. So if we move down here to kind of some of the learning targets, accounting cycle is a series of steps done in each accounting period to keep records in an orderly fashion. You're going to use a general journal to record the transactions of a business. When you move along in accounting, you'll find there are many different types of journals to record transactions. So I'm going to jump to section 6.1 on the accounting cycle. And here's a picture of it. I think it's my image in Schoology. The accounting period of a business is separated into activities called the accounting cycle. And so up to this point, we've just been working on this step here, analyzing each transaction. What is it? Is it a debit or credit? How does it affect the equation and whatever? And so that's just like a tiny step on the big accounting cycle. And so we're in chapter 6. We're going to get through these and we'll end up on these last two steps in chapter 10. So using what we've learned in how to analyze transactions, we're going to do the rest of these here. And then in this chapter, we are going to do the first 3 steps. So we're going to collect and verify source documents. It's kind of funny because what we've done up to this point is here are transactions. Well, when you're the accountant, no one lists the transactions for you. You actually get a piece of paper and you have to figure out what the transaction is. Once the transaction, you figure that out, you put it into debit and credit amounts. And then what we're going to learn new in this chapter is how to journalize those transactions, not using T accounts. T account, again, remember, was a tool. So our first step is to collect source documents. So, like I said, no one just gives you the transaction. So you're collecting paper, you're trying to figure out, that's why you have your CPA, you're analyzing the transactions, what actually happened. Did we pay rent? Did we put an ad in the newspaper? Did we have revenue? Did we sell products? Did we purchase new equipment? Whatever. All of that happens on a source document. So this is the evidence of the transaction. And so this chapter is going to talk about 4 types of source documents. The first one is an invoice here. And so an invoice is we either sold something or we bought something. And so we'll list specific information about a business transaction occurring from buying or selling. So if our name is up here on the top, we are selling. If our name is here in the to line, we are buying. And you'll see easy examples of that. So again, could be buying or could be selling. A receipt is like what we talked about as deposits. Cash is coming into the business. So cash is debited. We've had sales or something, and we have cash to deposit in the bank. I'm going to skip this one for a second, and then the check. We've seen that a lot where there's a transaction. It'll say check number 110. So a check is saying that we wrote a check, cash is going down, but it also has like a check stub, and it has what our current balance is in our checkbook. The fourth one, finally, is something called a memo or a memorandum, and it's like I don't have any of these 3. I don't have an invoice, I don't have a receipt, I don't have a check stub. So I kind of have to make one up. So a memorandum is used when no other source document exists that kind of helps you figure out what it is. And you'll see some good examples of that as we go along. We use these source documents to generate the transactions. We look at them. We would say we check the math on them. It's kind of funny nowadays we don't have math problems because it's all computerized. But the second step then is, okay, we have this receipt, we have this invoice. what account are we debiting, what account are we crediting, and we look through that. And so that's kind of what, I mean, that's a big piece, huge piece. That's what we've been working on in the first 5 chapters. Hopefully everyone has a good handle on that. And then the third step is the new piece to this chapter, is this new thing called a journal. So a journal is, you could think of it like a journal when someone writes in a journal, but it's a record of all the transactions. So it's kind of like a diary. So we're going to write down everything that happened today in our business transactions. Some people call it the book of original entry because that's where the transactions are first recorded. And so the third step is journalizing. Take those debits and credits and write them in a journal. And then 2 new terms that you need to know about for accounting period is there's a fiscal year and a calendar year. So a fiscal year is any 12 months. So for example, Westonka Public Schools, our fiscal year begins August 1st because that's when a new school year starts. And so our fiscal year is August 1st of the year to July 31st of the following year. Other businesses use a calendar year. A calendar year is always January 1st is the beginning and December 31st is the end, just like the calendar. And so not maybe as common because a fiscal year helps businesses do well, depending on whether you're retail or not, you might use a fiscal year. So beginning steps here in our new accounting cycle for section 1.